Hello, everyone. This is Paul Gigliotti in California MBA, and it's been a busy month for us. And I want to provide you with some timely updates on several key issues the California MBA has been actively working on, including the governor's budget proposal, as well as three important pieces of legislation affecting our industry. Let's start with the governor's budget proposal known as the May Revise. The California MBA recently joined a coalition supporting the May Revise proposal to establish the Disaster Rebuilding Fund. The proposal includes a $100 million investment to help expand access to construction financing for homeowners impacted by the devastating Southern California wildfires more than a year ago. The proposed Disaster Rebuilding Fund is designed to expand access to construction financing and other recovery resources. One of the biggest challenges facing wildfire survivors is the gap between insurance payouts and the actual cost of reconstruction. Even homeowners with insurance are finding that rebuilding costs often exceed their coverage amounts, making it difficult to move forward. The proposal would authorize the California Housing Finance Agency, or CalHFA, to manage a construction loan loss guarantee program, a construction loan rate buydown program, a low interest deferred payment subordinate loan program, and additional mortgage assistant tools. The intent is to also leverage private capital to expand the reach of the program over time. We support this practical, market-based approach that will help families rebuild. The Rebuild Fund is currently included in the state budget, and we expect the legislature to approve implementation through budget trailer bill legislation by the end of June. We've also been hard at work sharing our industry's perspective on two forbearance bills, AB 1842 and AB 1847. While we support disaster recovery efforts, we've raised concerns that elements of these bills may create requirements that conflict with existing federal regulation, investor guidelines, and operational realities of mortgage servicing. First up, AB 1842, the California Emergency Mortgage Relief Act. As originally introduced, this bill would expand existing disaster mortgage rules statewide anytime a state emergency is declared by either the governor or federal government, and would establish new obligations that go well beyond the current law. California MBA engaged extensively with the author and stakeholders to ensure policymakers understood how the proposal would interact with existing federal regulation, investor guides, and mortgage servicing requirements. As a result of those discussions, the bill was amended to address several of our key concerns. The amendments narrow when the bill can be triggered, replace the cascading payment processing provision with language that is consistent with current practices, removing restrictions on the transferring of loans and servicing rights, increased the flexibility of repayment requirements, and removed new reporting requirements. The bill was heard during the Senate Banking and Finance Institution Committee meeting this week. Based on the significant progress made through the negotiations, California MBA has removed its opposition to the bill as amended. A second bill, AB 1847, focuses specifically on borrowers impacted by the Los Angeles wildfires. As originally introduced, this legislation would have expanded forbearance from 12 months up to 36 months. The key issue here is alignment with investor guidelines. Mortgage servicers must operate within the requirements established by the institutional investors that own the loans they service. If state policy requires forbearance options that exceed what investors authorize, it creates a gap between statutory compliance and what can actually be delivered in practice. From a borrower's perspective, that misalignment can also create confusion about available options and expectations during what is already a difficult recovery process. The bill passed out of the Senate Banking Committee this week and passed with amendments. Those amendments reduced the maximum forbearance period from 36 months to 24 months and limit eligibility to borrowers whose properties have been rendered uninhabitable by the wildfire. While we appreciate the author's willingness to make changes, California MBA remains opposed to the bill at this time. However, the author committed during the hearing to continue working with stakeholders to address outstanding concerns. Finally, I want to provide an update on AB 801, the California Fair Lending Examination Act. When originally introduced, the bill would have imposed a Community Reinvestment Act or CRA framework on independent mortgage bankers. The California MBA opposed that approach because CRA obligations are designed for depository institutions and not aligned with the business model of our independent mortgage lenders. Independent mortgage banks already play a significant role in serving low and moderate income borrowers in minority communities. And we've consistently raised concerns that adding a CRA style framework could reduce credit availability for the very communities the policy is intended to support. We ensured California MBA members' perspectives were heard through extensive discussions, while the author, who then significantly narrowed the bill. The current proposal now shifts away from a CRA structure and instead would require the Department of Financial Protection and Innovation, the DFPI, to conduct fair lending examinations of banks, credit unions, and licensed mortgage companies at least once every 4 years. These examinations would evaluate compliance with existing federal and state fair lending laws, including the Equal Opportunity Act and the Fair Housing Act, and California's Unrules Civil Rights Act. We will continue to keep members informed as this bill moves through the legislative process. Whether it's disaster recovery, forbearance policy, or lending regulation, California MBA remains actively engaged to make sure policymakers understand how these proposals affect lenders, borrowers, and housing affordability across California. Thank you for your continued engagement and support.